Welcome to Safe Money Counselor TV, presented by the Selke Financial Group. I'm Randy Witt, but the important person on the screen right now is Jeff Selke. How are you?
So excited to be here and help people learn about their finances.
There's going to be a wealth of knowledge you're going to dive into, ladies and gentlemen. And since 2005, Jeff has been ranked among the top 1% of financial advisors nationwide. He's also the author of the book, Making Your Dream Retirement a Reality, and also lends his knowledge to listeners in Salt Lake City as host of Safe Money Counselor Radio that we've been doing together for years. And now, Jeff, let's talk about some of the seminars that you do. You help thousands of people every year at these seminars. They're very popular.
Yeah, I love educating. I love teaching classes, and we teach classes on all sorts of different topics, ranging from Social Security, basic financial strategies, as well as our most recent one that we've added is looking at the fees in traditional investment products, and especially the fees that you're not aware of, that are just hidden. And we're going to talk about that a lot today, and we do that in our classes. And the feedback we get from our classes is phenomenal. People really enjoy learning and the low-key manner in which I like to educate, which is, not in your face, trying to keep things simple, but also trying to educate you and really help you be aware of those things that you're probably not aware of.
You take the incomprehensible nature of a lot of this and make it very easy for folks to understand.
That's what we try to do.
So coming up next, Jeff is going to talk about some of the hidden fees associated with traditional investment products that you might not be aware of that could be eating into your financial future. Stay tuned. A happy and fulfilling retirement means different things to different people. For you, it may mean transitioning from a full-time career into meaningful part-time work. Perhaps you envision yourself spending more time with family or making regular visits to the golf course. Once you determine what will give you peace of mind in retirement, it's important to know how you can get there financially. Why put off planning? Why worry about unexpected challenges in retirement? Now is the right time to reflect on your retirement plan. We can help you achieve your short-term financial goals today while working towards your long-term goals for the future. Call now to schedule a meeting with the Selke Financial Group. And if you're one of the first 20 callers, you'll receive a free copy of Jeff Selke's exclusive Retirement Checklist. Call 877-488-4456. That's 877-488-4456. With the retirement checklist in hand, you can begin creating a detailed retirement plan that is structured to achieve your goals. Don't let another day go by. Now is the time to secure all aspects of your financial future. 877-488-4456 or visit safemoneycounselor.com.
Welcome back. Today we're going to talk about the fees in traditional investment products, and especially the fees that you're probably not aware you're even paying today. So first of all, to get started, I want to talk about the traditional way that most people invest. Most people are investing in mutual funds. And so if you own a mutual fund, you're really going to want to listen to this. And chances are you own a mutual fund. If you have any money in a 401k, in IRAs, or any kind of investment accounts, there's a good chance you have money in mutual funds. And let me explain some of the pros and cons. First of all, one of the advantages of a mutual fund is that they're very simple and easy to get into. You can have a little bit of money and start investing in a mutual fund. I actually started investing in a mutual fund when I was 6 years old and kept investing into it and adding to it as I grew up. As I was 8, 9, 10 years old, I kept adding money to it. And you could do that because it can handle small accounts. So that's the good part about mutual funds. Some of the disadvantages of mutual funds we've got listed here. You don't own the stocks and bonds in your portfolio. You own shares in a mutual fund. All that means is you don't really know what you own. There's no transparency. You don't know what stocks you own. I'd ask you, if you own a mutual fund, what stocks do you own? And you probably don't know. That's because you have no transparency. Who knows what you own? There are significant hidden costs, which we're going to go over in just a minute. The fund manager can be forced to trade stocks or bonds, whatever's invested in the account, based on other investors. What does that mean? If other investors, your money is pooled, as you can see here in the chart, your money is all sent to the mutual fund company and managed by the fund manager. Well, everybody else's funds are also going into that account at the mutual fund company. So your funds are commingled. you don't have an actual account at the mutual fund company. Everybody's funds are commingled. And what that means is if Sally here, who's invested alongside me in this mutual fund, gets scared and decides to sell her stocks or sell her shares of the mutual fund, that can adversely affect my shares. My share can go down. And so all of a sudden I lose money because a bunch of other people are selling out. Had nothing to do with me, but I'm going to lose money because of that. So just be aware, mutual funds, although they have some advantages, they also have significant disadvantages. Another one of the disadvantages of mutual funds are the tax consequences. And what I mean by that is mutual funds send out capital gains and dividends, and those are taxable to you. So when you get your 1099, if it's a taxable account, you're going to have to pay some taxes potentially on these capital gains and dividends. Whereas someone who owns the actual stocks and doesn't sell them isn't going to owe any taxes at this point. So because there's so many people in the mutual fund and the fund manager is having to buy and sell stocks all the time, that can cause adverse tax consequences to you. Now, the other type of way to invest, and this is a way that traditionally speaking was not available unless you had at least $1 million. And this is really how the big boys invest. And when I say the big boys, pension funds, endowments, think of Harvard and Yale. They do not send their money to a mutual fund at Fidelity or Vanguard or American Funds. They actually bring the manager into their account and say, okay, you manage this portion of our portfolio and you do it right here in our account. And that's how a separately managed account works. You don't send your money out to the fund manager. The fund manager comes to you and manages the funds in your brokerage account. What this does for you is it allows the money to stay in your account. You have full transparency. You know exactly what you're invested in. There can be no hidden fees because it's in your account. Your funds aren't somewhere off in La La Land where they could just be taken. You know, there can be fees being taken out of your account and you have no idea. This is your account, and so fees are not just going to come out of your account, and that's an important part of this. Also, you're going to have fewer transactions. It's going to be easier to donate stocks directly to a charity. So if you wanted to donate some of your shares to a charity of your choice, it's a lot easier to do in a separately managed account where you own the individual securities. So that's very important. Now, the disadvantage of separately managed account, there's really only one, and it's pretty much been that you've had to have like $1 million at least to even invest this way. And so that cut out some people. Well, now, today, with technology, it's gotten much easier to use separately managed accounts. Now, if you have 100,000 and maybe even less, you can get a diversified portfolio in a separately managed account inside your brokerage account. There's no more need, if you have at least $100,000, to send your money off to a mutual fund company. And let me explain a little bit more about the mutual fund companies and the fees involved, because I think this is going to make a huge difference for you. So, Wall Street's fee machine. I love this chart because this is going to show you a little bit about the fees that are involved when you invest. There are a couple of fees that you're aware of and that are totally disclosed that you should be aware of. So one of them is your financial advisor's fee or the custodial bank's fee. What that stands for is, and I call this above the line fees. These are fees that you should be aware of. If you're working with a financial advisor, they may be charging you a fee to manage your money, or they may be paid a commission on selling you an investment product. That is normal and that is disclosed. Another part over here on the right side is the money manager's fees. What that stands for is when you use someone to manage your money and you hire them, you're probably paying them a fee because they're out buying and selling the stocks and bonds. That is normal. Those are fees you should be paying. We all have to pay them in order to invest. Now, the below the line fees, these are the fees that are potentially, they are undisclosed and in many cases hidden. And these are the things that can really hurt your returns. Have you ever, I want you to think about this, have you been investing for a while and do you feel like you are constantly underperforming the stock market? Do you feel like you're constantly, consistently getting less returns than you should be? If you feel that way, there's a good chance it's due to the fees, and mostly the hidden fees in traditional investment products. Let me explain just a couple of examples real quick. One, right here we've got with fund structure costs, up to 7 layers of fees. Let me explain one of them. So in a mutual fund, you send your money off to a mutual fund. That mutual fund takes your money and buys stocks and bonds. Well, every time they buy or sell a stock or bond in your portfolio, that incurs a sales charge. That's going to incur a commission. Now, the fund company is not a charitable organization, so they don't just eat that cost. You're paying for that. They take that right out of your account. And let me explain an example from one of my friends who actually worked on Wall Street. He tells a story like this. He worked on Wall Street on the floor, and he'd get the call from a mutual fund manager who would say, hey, I've got 1 million shares of IBM stock that I need to sell today. And so his job on the floor was to sell those million shares of IBM stock. So he would do that throughout the day. At the end of the day, he'd call back the fund manager and say, hey, I was able to do it. I got it sold and I got $47 a share. How much do you want? Now think about this. What does that mean? He would say to him, how much do you want? So the mutual fund manager would say, okay, take 2 cents a share and put that in my soft dollar account, and take 4 cents a share and put that in my hard dollar account. What is a soft dollar account? What is a hard dollar account? These are things, I've been doing this for over 18 years. I was not aware of these hidden costs inside of traditional investment products and mutual funds. What this is, these hard dollar and soft dollars, this is just fund money. So the brokerage account, the big bank on Wall Street, sticks this money into a fund, basically a bank account, so that the fund manager, anytime they want, can call up and say, hey, I want that money. I need to use it for this or that. Or here, pay this bill. This is absurd. These fees, that is just coming out of your account. Instead of you getting $47 a share, you're going to get $46.90 because they kept 10 cents out per share. And you think on $1 million, that's $100,000 that is kept out of your earnings that you didn't get. So just remember that. When your money goes off to a mutual fund company, you lose control, you lose that transparency, and they're doing some funny things behind the scenes at the big banks, at Wall Street, and that will hurt your returns. So if you ever feel like you're underperforming, this is just one of the reasons why. Now, as far as, I want to give you another example. Banks and brokerages, they're in-house funds. What this is talking about is if you think about if you have an investment account at one of the big banks, one of the big Wall Street firms, you assume that they're the biggest, they're the best, they're going to get you the best deal. Not so. And let me explain this. They have their own in-house accounts where, for example, let's say you want to buy Apple stock today. And so you call up your broker and say, get me some Apple stock, I really like it, and that's what I want to own. Well, they may have Apple stock in their own inventory. They call it their house inventory. And even though you could go out and maybe the best deal right now would be $125 a share, they may sell it to you at $125.20, and they're keeping that 20-cent profit per share. So you think you're just buying it at whatever the market cost is today, but really they're selling it to you for a little bit more than that because they're making money on it. And oh, by the way, they also charge you a commission and a fee to do all that on top of that. So they're making money hand over fist on you. So these are just some of the fees that you need to be aware of. And again, if you're curious as to why you're underperforming the market, this is a big part of why. These fees, these hidden fees that you have no idea you're paying, and that quite frankly, as a financial professional for over 18 years, I wasn't aware of some of these fees. So be aware, these are some of the hidden costs that are hurting your portfolio. Now, how do institutions invest? Again, how do the big endowments like Yale and Harvard invest? How do the pension funds invest? Again, they use separately managed accounts. They do not send money out to the mutual fund companies. They have the fund manager come into their portfolio. And that gives you complete transparency. That allows you to know what you own. You know exactly what stocks you own. If somebody says, do you own Apple stock? You can tell them. Whereas with a mutual fund, you have no idea. You have less turnover because your assets are not commingled, so you don't have to worry about selling shares because of someone else's decisions. You have more favorable tax treatment, and you have the ability to customize. You can customize your portfolio. If there's a certain stock or bond or some company that you don't want to be any part of, you can do that in a separately managed account, whereas in a mutual fund, you have no choice. You have to be in whatever investments the mutual fund manager thinks are good. So I want to show you this. This is showing the year 2008 and actual returns from the average mutual fund and the average SMA, which stands for separately managed account. And if you look at the returns, in 2008, everything was horrible, right? Everything went down and you probably lost money. Most people lost between 30 and 50% of their investments. We know real estate went down 30 to 40 to 50%. Everything was terrible that year, right? Well, this is a comparison of funds. And if we look at this, just to look at the top line, large cap core. So this is a large company fund. So you're putting your money to invest with a fund manager who invests in large companies. That's going to be the everyday companies you hear of all the time. Procter & Gamble, AT&T, Verizon, Apple, Google, all those types of companies, ExxonMobil. So the same fund managers in a mutual fund, they earned negative 38% that year on average, whereas the average SMA in that same category was negative 34.8. Well, why is there a 3.2% difference when it's the same fund managers, the same strategies? Why would it be 3% different? The reason are all those hidden costs that we just spoke about. 3% a year. On average, 2.5% a year in the various different types of funds. So just be aware, this is real. You're losing somewhere probably between 2 and 3% a year just to these hidden fees in your mutual funds. Now, what does that mean in dollars? Look at this. 2.5% difference in return is huge. For example, on $1 million invested for 10 years, at 7.5%, you're going to have $2,061,000 10 years from now. At 10%, 2.5% more, you're going to have $2,594,000. That is a difference of over $500,000 in 10 years. That's a big difference. And that was just the difference with those hidden costs, those hidden fees. That's costing you over your lifetime, who knows how much? Hundreds of thousands, if not millions of dollars. So be aware of this. We wanted to educate you on this because this is a subject that most of us are totally unfamiliar with. We just think we're paying some fee to a financial person, or maybe the mutual fund company is charging us their expense ratio of 0.7 or 1% or whatever they're charging us. But the truth is there are all sorts of hidden costs, and it does affect your future returns and your future retirement. Now, I want to show you a real life example and how this can affect someone. We just did an analysis, we call it a portfolio review of a client's portfolio, or potential client's portfolio. This particular couple has $400,000 invested in 4 different mutual funds. Their turnover ratio on average is 83% a year. What does that mean? Turnover ratio stands for how much of the portfolio was sold and bought again. So basically, the fund managers sold almost every stock and bought all new stocks during the year. What do you think all that churning or movement of money causes inside your portfolio? It causes fees, of course, because they're trading constantly. So that's an issue. 334 total holdings. The average 10-year return for this portfolio was 6.6% per year. Well, that's not bad, 6.6% per year. Many of you probably would love to have 6.6% per year. But let's compare that to the same type of portfolio, but in separately managed accounts rather than mutual funds. Same strategies, same portfolio. Look at this, 25% turnover ratio. So it reduces the turnover ratio substantially. Not being in a mutual fund, having the funds managed in your account makes a difference. That means less fees. 145 total holdings, so about half the number of holdings. 10.3% average rate of return over the last 10 years. Think about that. Look at that difference in returns. What does that mean in real dollars? $400,000 invested 10 years later at 6.6%. You've got about $765,000 in your portfolio. Not bad. Didn't quite double, but almost. Same holdings in the separately managed account with lower fees, $1.1 million. Now that is a, $350,000 difference in 10 years? That is substantial on a $400,000 investment. This is why this is so important that you understand the fees you're paying. One of the things we do for our clients and people who want to take advantage of this service that we're talking about here on the TV show is we'll do a portfolio review. If you have over $100,000 invested in mutual funds, in variable annuities, in a stock account, whatever it is, we will do a portfolio review to figure out how much you're paying in fees, what fees are disclosed, what fees are not disclosed, and how that's going to affect your portfolio over the long term. And is there anything better you could be doing? That's a big part of what we focus on. I want to give you one more example before I move on. Target date funds. These have become very popular inside of 401k plans. Target date funds, the idea is great. The idea is you put your money into a mutual fund and it slowly becomes more conservative over time. It slowly moves from stocks to bonds. so that as you get older and as you get closer to retirement, you have more money in bonds, less risk. That's the idea, and it's a great idea. But here's an example of a real target date fund and what we were able to find by doing our portfolio analysis. This target date fund has its own annual expense ratio of 0.77%. Totally normal. That's a good fee for a target date fund. There are 27 stock and bond funds inside of this one fund. So think about that. There's 27 mutual funds inside of another mutual fund. So you've got all the fees associated with those 27 funds. That's an additional expense ratio of 0.73. So right there, we add those two together, you've got a total disclosed expense ratio of 1.5% per year. So right now, you know you're paying 1.5% per year. Okay, even that's not unreasonable, but what are the other fees you're paying? You still have all those internal fund fees, those hidden costs, those trading costs inside the mutual fund. So you're probably paying another 2 or 3% a year in fees on top of what they're telling you. That is substantial, and that is going to hurt your portfolio. And that's why most of these target date funds underperform the stock market. So just be aware of what you own. Also, when you own 27 mutual funds, this particular one, you own 6,200 stocks and bonds. That essentially makes your portfolio a massive index fund. Why not just buy an index fund or an ETF, an exchange traded fund that just mimics the market? That would be better than this because it would reduce those trading costs. It would reduce your fees that you're paying inside the fund. So this is definitely not the best way to go for most people, even though this is what's being pitched mostly in your 401k plans today. So just be aware of that. The pros, the best fund managers in the world, tend to own less assets, not more. As I told you with that target date fund that owns 6,200 stocks and bonds, which just makes it a massive index fund, the studies show that the less number of securities, probably the better, that you shouldn't own 6,000 stocks and bonds. You should probably own 20 to 40 to 50, not much more than that, because if you have too many stocks in your portfolio, you're just mimicking the indexes and you're paying a lot to do it in traditional investment products. So fund fees matter. Returns matter, of course, to all of us. We all want to get the best returns we can possibly get. We all want to maximize the savings that you've worked so hard to save and your retirement dollars that you've saved in your 401ks and IRAs. The way you're going to do that is by making sure that you have a good review of your finances, that you understand what you own, that there's transparency, and you know what fees you're paying. Because if you don't know what fees you're paying and you don't know how you're invested, how are you going to know if you're doing well? Other than by looking at how much money you have. And you're probably looking at it each year and thinking, boy, it feels like I'm not growing. It feels like I'm not going anywhere. These fees are the reason why. And that's why I wanted to educate you on this at this point. I think it's important for all of us to understand the fees that we're paying in traditional investment products so that we can hopefully make better decisions and hopefully figure out how to maximize our retirement income by lowering our fees.
A happy and fulfilling retirement means different things to different people. For you, it may mean transitioning from a full-time career into meaningful part-time work. Perhaps you envision yourself spending more time with family or making regular visits to the golf course. Once you determine what will give you peace of mind in retirement, it's important to know how you can get there financially. Why put off planning? Why worry about unexpected challenges in retirement? Now is the right time to reflect on your retirement plan. We can help you achieve your short-term financial goals today while working towards your long-term goals for the future. Call now to schedule a meeting with the Selke Financial Group. And if you're one of the first 20 callers, you'll receive a free copy of Jeff Selke's exclusive Retirement Checklist. Call 877-488-4456. That's 877-488-4456. With the retirement checklist in hand, you can begin creating a detailed retirement plan that is structured to achieve your goals. Don't let another day go by. Now is the time to secure all aspects of your financial future. 877-488-4456 or visit safemoneycounselor.com. Welcome back, ladies and gentlemen, and wow, see that right there, that presentation is what sets you apart from other financial advisors. You have such a wealth of knowledge, and again, how easily you make all that information comprehensible to the common folks. It's really great.
You know, it's a lot of information, but comprehensive financial planning is so important, and that's really what sets us apart, is helping educate you on the fees you're paying in your financial plans, as far as making sure you're maximizing your Social Security and your retirement income, looking at your entire picture, your estate planning, your tax planning. It's all important, and if you're not looking at everything, you're missing something.
A lot.
A lot.
And people, you can learn more about Jeff by picking up his book. It's called Making Your Dream Retirement a Reality. Jeff, talk about the book.
Yeah, I wrote the book a few years ago because so many people from my radio show were calling in and clients and saying, can't you just put all that information that's in your head on paper? And so finally, after years of working on it, I did. And my goal of writing the book is to help you have your dream retirement. That's why we came up with the title, Make Your Dream Retirement a Reality. If you read my book and follow the principles taught in it, it's meant to be a blueprint for you, to show you how to have your dream retirement, how to have the income you need to last a lifetime.
It's a great read. It's a very clear read. Folks, pick it up. Make Your Dream Retirement a Reality by author, TV host, radio host, all-around great guy, Jeff Selke.
Yeah, and if you visit the website dreamretirementbook.com, you can actually download a free chapter of our book. So that way you can kind of test it out and see if you like it. And I hope you do.
Ladies and gentlemen, Jeff can provide comprehensive financial planning strategies that will help make your dream retirement a reality. And that's all the time we have for today. Thank you very much for watching Safe Money Counselor TV. A happy and fulfilling retirement means different things to different people. For you, it may mean transitioning from a full-time career into meaningful part-time work. Perhaps you envision yourself spending more time with family or making regular visits to the golf course. Once you determine what will give you peace of mind in retirement, it's important to know how you can get there financially. Why put off planning? Why worry about unexpected challenges in retirement? Now is the right time to reflect on your retirement plan. We can help you achieve your short-term financial goals today while working towards your long-term goals for the future. Call now to schedule a meeting with the Selke Financial Group. And if you're one of the first 20 callers, you'll receive a free copy of Jeff Selke's exclusive Retirement Checklist. Call 877-488-4456. That's 877-488-4456. With the retirement checklist in hand, you can begin creating a detailed retirement plan that is structured to achieve your goals. Don't let another day go by. Now is the time to secure all aspects of your financial future. 877-488-4456 or visit safemoneycounselor.com.